I think commodity prices as a whole are likely to rise, measured in again, and I make this point, the declining purchasing power of our Western currencies. And this is one reason why, if you look at the purchasing power of gold measured in commodities over long periods of time, it's very, very stable. You're looking at the same argument from two different points of view, because gold is representing, if you like, theoretically, a basket of these commodities. So I think you can go beyond just gold, and I think silver I see enormous demand for. To my mind, that is very, very underpriced. And I think as Western markets fracture, which they're bound to do, you'll see that the potential of silver may well be unleashed.
Throughout 2023, the resilience of gold prices has been remarkable, notably soaring to an all-time peak of $2,135 per ounce this month. This surge occurred in defiance of the U.S. interest rate, which hit its highest level in over 2 decades. Despite the robust U.S. dollar and rising Treasury yields, gold prices began the week by reaching $2,033 per ounce, surpassing a resistance level. This ascent followed a slight decline from its peak at $2,152.30 per ounce, signaling an attempt to gather momentum again. Alasdair Macleod, an expert from Goldmoney, believes that commodity prices are on the brink of a surge due to the declining purchasing power of Western currencies. Over extended periods, gold has shown remarkable stability in its purchasing power concerning commodities, representing a basket of these goods and underscoring its enduring value. Alasdair sees substantial potential in silver, deeming it undervalued, particularly within the context of potential fractures in Western markets. He anticipates gold prices in dollars falling below $2,000 due to possible manipulation by financial institutions like bullion banks aiming to improve their year-end financial positions. Despite the prospect of short-term fluctuations, Alasdair emphasizes the stability and resilience of gold as a tangible asset amid economic uncertainties. This outstanding performance in gold prices could be attributed to heightened demand from central banks and safe haven flows triggered by geopolitical tensions in the Middle East. These factors counteract the adverse impacts of rising Treasury yields and the robustness of the U.S. dollar. Alasdair further notes a significant shift among central banks towards gold, interpreting this trend as a move away from credit-based currencies. The World Gold Council reports a significant uptick in central bank gold purchases, reaching 800 trillion tons year-to-date as of 3Q 2023, a 14% surge from the prior year. In the third quarter alone, central banks acquired 337 tons, notably from China, plus 78 tons, Poland, plus 57 tons, Turkey, plus 39 tons, and India, plus 9 tons. This consistent buying, alongside increased investment demand, fuels positive predictions for gold prices in 2024. We will present clips from Alasdair Macleod's interview with Soar Financially. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
In the very short term, the reason I think you're not seeing any sort of excitement or follow through or whatever is because markets are just very, very quiet. I mean, you've got these conditions in which equity markets are going up. You've got a few people sort of maybe getting into bonds before the prices rise even more. Ha ha. These markets, they don't actually reflect any sort of reality. I would not be surprised, Kai, to see the price of gold in dollars dip below 2,000 again. Why? Because the establishment of bullion banks, which are short in COMEX, and I guess are pretty short on an uncovered basis in terms of their overall liabilities in London, want to get it done in order for their year-end valuations to not look as bad as they might otherwise look. So I wouldn't rule out in these very quiet conditions. I mean, if I was a bullion bank, I'd be going around to the Christmas drinks with my mates in the other in the other banks and saying, when are we going to hit this price? How much can you do? I reckon I could probably do 10,000 contracts. What are you, Charlie? What do you reckon? Come on, have another beer. Come on, tell us. Don't rule out another smash in the dying days. But if that happens, I mean, it's so against what is actually going on in terms of the value of credit. Get rid of credit, get into gold to say thank you for the opportunity. And it's interesting, what has been driving demand for gold has been, I mean, you could actually say it's liquidation of credit by central banks. They're getting out of each other's currencies. They're getting into gold. They're getting into gold because gold is real legal money, always has been since Roman times, going back to the 12 tables of 553 BC, would you believe? No, 549 BC to be accurate. Refined and refined and refined until Justinian's Pandects. That was 553 AD, and the Basilica, about, I don't know, 400 years later, and so on. And of course, the successors to the Eastern and Western Roman empires were all us Europeans, and we explored the world. We went out and colonized the world, and we took our laws with us. And the Chinese, even though we didn't colonize them, we sort of maybe had a bit of influence with trade and so on, they came to exactly the same conclusion independently of us, that gold is money. And someone told me, and I can't verify this, that the Chinese for gold is the same as the Chinese for money, presumably in Mandarin rather than Cantonese. But anyway, so, the world understands that money is gold and all the rest is credit. But in the West, we've forgotten it. We've been subjected to propaganda that gold is now a pet rock and the dollar is money. It's not. The dollar is a liability of the Fed. It's the Fed's dollar. It's not even a US government dollar. It's the Fed's dollar. It's their liability. And if you have trust in the Fed, well, good luck to you. Good luck to you.
The historical trend of devaluing currencies points towards an inevitable downfall of fiat money. It's anticipated that currencies will collapse in real terms, prompting a surge in gold as a safeguard against this decline. There are concerns about the reliability of the Western banking system, predominantly controlled by the U.S., as a secure reserve holding, potentially leading to the dollar's collapse as a reserve currency. Alasdair foresees a persistent decline in currency values through 2024, which could contribute to an inflationary trend. Furthermore, banking institutions believe the silver market is manipulated and suppressed. However, the potential for a substantial surge in demand and price exists if this manipulation were exposed and the monetary system collapsed. Alasdair highlights a discrepancy between the high demand for silver and its current price. He attributes this dissonance to emotional price setting in paper markets that fail to reflect the actual demand-supply dynamics accurately. Despite robust demand, the prevailing silver price is considered inaccurate due to market mechanisms that inadequately regulate prices. This discrepancy is symptomatic of broader issues in determining market prices, particularly in commodities like silver. Let's return to the interview.
Basically, there's all this puff, puff, puff going into the year end in thin markets. Markets are rising, and guess what? Whenever that happens, it peaks on like January the 2nd, the first day of the trading day of the new year. And then it's downhill from there without stopping for quite some time. This is a false world, financial world we're living in. I mean, it's just crazy. But the one thing I see, I'm not sure that we're really sort of on to 2024 yet, but this, to me, in my mind, is an extremely good background for the gold price. But I always emphasize, and I just wish people would understand this, they don't. It's very hard. It's for some reason a very hard concept for people to understand that it's not gold going up, it's the dollar going down. It's the euro going down, it's sterling going down, it's the yen, it's the purchasing power of the currencies declining. And the inflationary outlook is that decline is going to increase and increase through 2024. So what does that mean for interest rates? Well, they're not going to fall as everybody expects. They may be able to engineer a small fall somewhere down the line if, let us say, the Houthi thing doesn't blow up in our faces in the next few weeks. But, what's the purpose of interest rates? It basically is the time preference that foreigners require, and it's foreigners who will decide this. But I mean, this, the extraordinary thing with many, many commodities, I think less so perhaps with oil, but with many, many commodities, the price is actually based on this emotional price setting in the paper markets, because deals just don't go through the market. I mean, they just reference to the market. And, when you look at what's going on with this huge demand for silver, which we all know about, why isn't the silver price shooting up? I mean, it's doing its traditional thing of moving twice as much as gold. Gold goes down 1%, silver goes down 2%. The reason that the demand is not reflected in the price is that everybody looks at the price and says that is the basis of the contract, but it doesn't go through the market. I mean, the market actually doesn't work as a price regulator, if you see what I mean. So, the oil price, I don't think is something which really is all that meaningful. The Fed, I'm sure, watches that. But to my mind, I think Fed policy is set more by the information which comes in from their regional offices about the economic conditions up and down the country. Now, until recently, they have emphasized very, very strongly on trying to control inflation, getting inflation down. But that's only one of their mandates. The other mandate is consistent with full employment. And if they see that the economy is tanking, then, or the indications are they're tanking, and we've just agreed that this is the situation here, I think the priority has shifted for that reason. And I don't think that the Fed takes into account geopolitical things at all. I really don't.
If the Federal Reserve maintains a less aggressive stance and shifts the narrative on interest rates, the overall environment for gold could improve. Additionally, ongoing efforts by central banks to strengthen their gold reserves emphasize the enduring allure of this precious metal. What factors do you think will influence the future direction of gold prices? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.